Imagine you're browsing an online real estate listing and you spot a house with an outrageously high asking price. The photos look nice, but the paint is peeling and the gutters are sagging. That listing price is just the seller's opinion. It might be inflated by wishful thinking, or they could be trying to hide a cracked foundation under a fresh coat of paint. When you look at the stock market, that blinking number next to a company's name is the exact same thing. It's just the crowd's daily opinion of what a single share should cost right now. This animation shows a scale balancing a jumping price tag against a solid, unchanging core. That core represents a company's intrinsic value, its true worth based on its actual assets and earnings, regardless of the daily noise. Smart investing isn't about guessing which way the price tag will swing tomorrow. It's about acting like a home inspector to find that true worth yourself. This is the process of looking at the business, not just the stock. The first step of any good inspection is checking the guts of the building. You want to make sure the structure is solid before you worry about the decor. This graphic shows a home inspection checklist merged with a financial report. We are looking for simple, hard facts. Is the company actually turning a profit? And is it avoiding scary levels of debt that could bring the whole house down? Once the structure checks out, you have to look at the neighborhood. This means evaluating the things that don't show up on a blueprint, like a company's reputation. This diagram shows a headquarters building protected by a moat. In business, a moat is a unique advantage, like a famous brand or a secret recipe, that protects the castle and keeps competitors from stealing its customers. A moat keeps a business safe, like a trusted name, or a system so convenient customers won't leave for a rival. You also have to check out the landlords, a management team. You're looking for leaders who treat the company's money as carefully as if it were their own. When you find a healthy financial structure in a protected neighborhood, you know you're looking at a business that was built to last. Now that the inspection is over, you need to calculate a specific price. You need an appraisal to figure out what the business is actually worth in dollars. The first way to do this is by checking the neighbors, looking at what similar companies in the same industry are currently selling for. If our target company is growing just as fast as its neighbors, but its price tag is much lower, we might have found a bargain. The second way to find the value is by looking at the home's potential to earn money for you over time. This timeline shows how we calculate that earning power. Think of it like renting the house out. We estimate all the cash the property will generate over the next 10 years. Then, those future coin stacks slide backward to today, shrinking slightly, because $1 today is worth more than $1 tomorrow. Adding up this adjusted cash gives a concrete estimate of what the company is worth. This number gives you a target price based on an actual business, helping you stay calm when the market gets noisy. Let's say your math shows the company is truly worth $100 a share. But suddenly, the news reports that parts are stuck in a factory halfway around the world. The market panics, and the price tag on your screen drops to $60. This chart compares our target price of $100 to the panicked market price of $60. That $40 gap is your margin of safety. It's your built-in protection against mistakes or bad luck. You only buy when this cushion exists. You don't need to be a professional to do this. You just need the patience to ignore the blinking lights, inspect the business like a home buyer, and wait for a great company to go on sale.